You know, there was a time when getting a business loan came down to a handshake and your good name. Well, those days are fading, and fast. But here's the twist. It's not because banks suddenly started hating relationships. No, it's because the pure economics of banking now rewards something else entirely, standardization. So let's dig into what's really going on here. And this quote really hits the nail on the head. This whole shift, it's not personal, it's structural. It's not about feelings, it's about a massive rethink of banking economics, driven by technology, risk, and new regulations. To really get this, we have to look at how banks even think about risk now. It's a huge pivot away from, personal judgment and gut feelings, and a full-on sprint towards pure, cold, hard data. So on one hand, you had the classic model, relationship banking. This whole thing was built on what we call soft information. A loan officer really knowing you, your character, your business, the local market. But on the other hand, you have the new reality, transactional banking. And this is all about hard information, credit scores, algorithms, stuff a computer can easily read. The entire industry has been moving from the left side of your screen to the right. So you might be asking, how did we get here? Well, this didn't just happen overnight. It was more like a perfect storm of powerful forces that basically pushed banks away from that old model. There were really three core drivers. First, after the 2008 financial crisis, you got way stricter regulations like Basel III. Second, there's just been this relentless pressure to cut costs and squeeze out more profit, and the old relationship model was, frankly, expensive. And third, the big one, the digital revolution handed banks all the tools they needed to automate, well, just about everything. And these regulations, like Basel III, they really changed the game. They forced banks to hold more capital in reserve for what they see as riskier loans. And guess who often falls into that riskier category? Small and medium-sized businesses. So banks now have a huge incentive to either lend less to them or to standardize the whole process to keep that risk under tight control. Okay, so we've covered why this all happened. Now let's get into the how. How exactly did banks build this new kind of decision-making machine?
The big idea here is something called portfolio optimization. Instead of looking at your loan on its own merits, banks now look at how your loan impacts the risk of their entire portfolio. It means your individual relationship takes a backseat to the stability of the system as a whole.
And this transformation happened in three pretty clear steps. First, they digitized everything, moving from branches to apps. Second, they started hardening all that soft info, turning everything they knew about you into a number. And third, they centralized risk, taking the power out of the hands of local managers and giving it to automated models sitting in headquarters. And what's the end result of all this? Well, it's pretty simple. That experienced loan officer's discretion, it's been systematically replaced by credit scoring and machine learning models that care more about consistency and efficiency than anything else. Take a look at this simulation. It shows you exactly how this works in practice. A bank can literally program its risk strategy into the system. The green line, that's a risk-tolerant strategy. The orange line is risk-averse. The key thing to see here is that a person isn't making these calls loan by loan. A machine is executing a preset strategy across the board. So, what does all this automation and data mean for the small and medium-sized businesses that are really the backbone of the economy? Well, the consequences are direct and they are profound. The job of a relationship manager has been totally flipped on its head. They now have to work within these rigid, automated RM limits. This means even if they believe in a client, they can't just use their own judgment to override the system. Getting an exception means battling a centralized risk department, and that's a tough, uphill climb. This table lays it all out, clear as day. Manager discretion, gone from high to almost zero. The amount you can borrow against your assets, the loan-to-value, is now way more rigid and often a lot lower. And your loan terms? They used to be stable. Now, they're volatile, changing almost instantly based on the market or your latest data. And that change in how much collateral you need, it's not a small thing. We're talking about a drop in loan-to-value ratios of as much as 26%. What that actually means is that businesses have to pledge more of their own assets to get the same loan, which ties up capital that they could be using to, grow.
So it kind of sounds like the human element in banking is just gone, all right? But is that the whole story? Or has it just changed its shape?
This is the big question, isn't it? After all this, has the algorithm just completely killed the value of a long-term, trusted banking relationship?
Well, here's the answer. It's not gone. It has been translated. It's been converted into a language that the new automated system can actually read and understand. And this right here is the key to understanding everything. Your history with the bank, your reliability, your character, all that soft stuff is now just another set of data points. Your relationship has been quantified, scored, and fed right into the model. It still matters, but now it lives inside the system itself.
So where do we go from here? Well, the future looks like it's going to be a hybrid or phygital model. That means digital platforms will handle all the routine, standardized stuff super efficiently, freeing up human bankers to focus on the really complex cases, the situations that need judgment and a real personal touch. It's about letting machines handle the predictable so humans can navigate the exception. And that really is the tightrope the entire financial industry is walking. How do you get all the stability and efficiency of a standardized system without losing that crucial human insight that actually fuels innovation and growth? That is the billion-dollar question that's shaping the entire future of finance.